Welcome back to Rockstock Channel. It is Wednesday, May 29th, and we have back on the program our good friend David Deckelbaum of TD Cowen. This is a Rockstock recap episode. The first quarter earnings season is now essentially complete in lithium, and TD Cowen actually had a sustainability conference last week, and David had 9 critical minerals companies under coverage at that conference, including Arcadium and Lithium Americas and Piedmont and I think Sigma Lithium. So he put out a fresh note with his takeaways from that. So I definitely basically want to start with that, David. And then Rodney's here. Rodney's updated his models since the SQM results came out, and Greenbushes and commentary from IGO, et cetera. So we're just going to talk broadly what's happening in the market. We had an uptick, and everyone was like watching on Twitter every day what the price was about a month ago. And for the past month, they're not tracking every day. We kind of like flatline, waiting for the next move here. Paolo Roya put out a funny meme, which I retweeted. We'll put this up here about lithium investors, just waiting for the price to rise. So anyway, David, welcome back. Why don't you just tell us your thoughts post this conference, like any fresh material that came out of any of the interviews from the CEOs.
Yeah, thanks, Howard, and it's good to be back amongst friends. Howard and Rodney, good to see you guys. Look, yeah, I think I don't know which music resonates with you the most, whether it's like waiting in vain, or I don't want to wait in vain, or the waiting is the hardest part, or Guns N' Roses, Patience. You have a whole litany of options here to choose from. But I think it was also that kind of characterized, I think, a lot of the conversations that we had with executives that were there, that, I think that there was some optimism, I think, on the part of, John Evans from Lithium Americas said that he thinks we're going to be over $20,000 a ton by the end of the year. And that was predicated on his view that we're seeing a destocking in China, and a resurgence in demand, and that we're seeing supply correction. And I think, arguably we're seeing obviously supply of new projects being pushed out. I think one of the things that we talked about last time we were on here is that you haven't really seen an appreciable slowdown in brownfield expansions, and there's not enough of a pullback in actual capacity that was already available to the market. I think you've seen much more of a market share battle going on in the interim. We don't necessarily share John's optimism. I hope that I'm wrong for the sake of the broader market, but we think that there is very much a period of, maybe a hurry up and wait, or don't hurry up and wait, but just wait. And that there's very little in our view to push us out of this band. And I think what you found from a lot of the other executives is that they feel like right now that they're more able to more or less earn a margin, that they're able to focus on cost efficiencies right now. I think you're seeing that at areas like NAL with Sayana, and obviously Piedmont as a JV partner, where they're focused at bringing down operating costs to make money at $1,100-$1,200 a ton spodumene. And that, I think, for folks like Arcadium that are well capitalized, they're continuing to expand with the growth initiatives that they had, albeit obviously managing some of that capital. I'd say holistically, particularly as we think about it on the investment side, the entire, I think, narrative a couple of years ago was really about like reshoring the supply chain in North America for the benefit of Western OEMs. And I'd say on the margin, it still feels like obviously that market is right sizing and a lot of those projects have been delayed. But it seems like there's quite a bit of interest still from the likes of Arcadium, even from Piedmont. Lithium Americas obviously has an agreement already in place with GM. But it seems like there's still optimism around the long-term demand from US-based OEMs and continued interest on the partnership side of bringing supply here. But I think a lot of folks, are taking much more of a cautious approach to this, waiting obviously until after the election is over, until they have a bit more clarity around how much enthusiasm there will be around the electrification theme. And I think that's obviously pretty prudent. It probably doesn't catch anyone by surprise right now.
All right. Thanks, David, for that quick summary. So I do want to cover some election thoughts. I listened to the Paul Graves interview, or half of it, and two things stood out in what he said for me was the caveats. So he said 20,000 is the needed as an incentive price for North American supply, right? From a Western OEM point of view, right? So that was like a caveat and a nuance that's different. So 15,000, 16,000, whatever, they could still make money, on targeting China, but to make investments like in North America, Quebec, et cetera. The second thing that he said was that he started talking more about Bessemer City as a place to convert the James Bay material. And that to me seemed to be, he was like playing, the U.S. off of Canada, which has talked a lot about incentives, but hasn't actually provided them to him. Whereas the U.S., IRA, has that. So I don't know if he's playing himself off, or he's actually penciling out the math and said, with these incentives, it's better to truck it, or boat it, into Bessemer City. But, if that were to happen, then that whole hydroxide hub that we've been talking about for a long time in North Carolina, there's Piedmont and there's Kings Mountain, could be interesting. But that goes into your question, waiting on the election. And you said this retooling of the supply chain, which has been a major theme. It's a question, right? Like how committed to the EV supply chain or EVs and the necessity. Yes, Trump will believe in critical minerals, but if he de-emphasizes EVs and he guts the Loan Programs Office or some of the other incentives in the IRA, what are your thoughts about that? We probably should talk to John Miller, your colleague, more on that. But all of your executives were basically saying, we're just waiting. We're in this mode of we don't know.
I think there's a lot to unpack in there and how the election pans out. But I think let's start from where we are today, where U.S. demand or U.S. EV sales peaked last year. And we've really kind of stagnated. And Europe has been fairly atrocious as well. So we haven't really seen material growth from those areas. And I think the hope is that you'll see demand materialize stronger in the back half of the year. There's some seasonality there, but the seasonality is typically more pronounced in China. But leaving that aside, you go into now, about a month ago, I suppose you saw the Biden administration levy some tariffs, quadrupling the tariff on Chinese imported EVs. Which can be pseudo laughable because I believe that we import Polestars and nothing else. So it's not a really material part of the market, but obviously had some political implications during an election year of appearing tough on China. I cover MP materials and minus rare earths. So there was some impact as well to putting tariffs on permanent magnets coming into the country in 2026 and beyond. And again, I think there's a lot of actions right now that capture headlines, but don't necessarily fundamentally change, economics that are out there. And then you get into what can happen. And I think certainly under a Trump administration, during the last Trump administration, we saw increased tariffs on China. Perhaps you see more tariffs on batteries, electrification, things like that. But I think broadly speaking, there's also the reality that many of the battery factories are located in red states. So you would be inherently punishing your constituency. And, I think practically speaking, right, our House view at TD Cowen is that the IRA is codified in law, and that it's extremely difficult to repeal law, and it's unlikely that would happen, but you could see some consumer incentives being rolled in the event that there's a Trump administration win. So a lot of just unknowns, but I think for broadly speaking, I think you raised a bigger point, which is lithium pricing is fairly moderate right now, if not weak. And if you believe that we're in this, mid-cycle, albeit weak price environment, you're not incentivizing new expansion in North America. So you really have to have confidence, I think, that you're going to see continued government support. You wouldn't rightfully underwrite any of the projects that we know about in North America right now in this price environment if you were paying for them yourself. So I think you need to see that entire collaboration that goes all the way up to the OEM, but obviously beyond to the Loan Programs Office, which obviously began during the Bush administration and is bipartisan. But I think you want to see, this continued commitment where perhaps there's some semblance of confidence that capital markets can participate with this ongoing EV expansion. And for those that are out there, I think it would be, you look at the equity values, you would be foolish to go out there and overly market and overly raise capital right now to try to address your needs when you have a view that the market is going to correct, or at least that you're paid to wait at this point to get better clarity into next year.
The one topic I would touch on, David, you mentioned in terms of the tariff on the EVs, but there was also a material increase on the tariff on battery.
Yeah.
And that has a material look-through impact because that you can't, there is meaningful imports on that. So your thoughts on going, I think, from 7.5 to 25?
I think, again, there's a phasing of that. And that I think that we're in this world right now where it's like, as you try to bring down the cost of the battery and the cost of an EV, and again, fight with that affordability argument with the American consumer, on the margin, that obviously doesn't help in particular. But you've also seen in general, I think, some other issues related to adoption in the United States and North America that I think are more at work than just the cost equation. We've seen the argument, obviously, about higher interest rates making it more expensive. The charging network, that proliferation hasn't taken shape with the pace I think that most people thought that is required. I think you are seeing this stagnation of consumers that were early adopters, then now moving to that next wave of adoption, which perhaps needs to be just more incentivized economically speaking, and that's obviously not there right now. And that $7,500 EV tax credit isn't necessarily enough in some cases to fight that price parity.
Yeah, and I think that's fair, but I do see data suggesting that non-Tesla EV sales are not bad and not pivoting as quickly, but they're not bad. It seems like Tesla's kind of played out. You think some staleness in the models might be coming out here now, and then, the Cybertruck, the production doesn't seem to be as easy as first envisaged.
Yeah, obviously, with Tesla being the bellwether in the United States, and to your point, stagnations and model lineups, and I don't cover Tesla, but I think it's obviously clear that others have taken share, particularly in other parts of the world. But in the United States, I find it fascinating. If you pragmatically just go overseas and you check out BYD's lineup, I think many people would be amazed and astonished at how competitive these cars are and how impressive they are. So from my personal selfishness, I wish that we could import BYDs into the United States because I would buy one. And there are incentives, and I'm sure that you're going to see BYD aggressively taking share in other markets, including Europe. And I think that's obviously inevitably impacting what's going on with Tesla. But I think you've also naturally seen, I think, a saturation of that brand, which is normal with many brands. And I think to your point, I think a lot of folks waited for the visibility around the next generation of a lower cost EV from Tesla, which really hasn't been rolled out. You've seen much more of a focus on autonomous driving and robo-taxis. And to your point, the Cybertruck, it was never a mass scaled vehicle. But there's obviously been some negative headlines around that as well. And now you have this moment where you're waiting for the US OEMs to catch up, which, I don't know, that could be half a decade, right?
And that raises a broader question, David. If you look at auto exports, they've come from nothing in 2021 to number one last year, and this year likely to hit 6 million. I don't know exactly the number in EVs out of that 6, but it's probably going from 1 to possibly even as high as 2. Your
Mm-hmm.
thoughts on markets where there is no protectionism for domestic production, etc., where you just everyone competes? Your thoughts on how quickly China, the likes of BYD and others, can snap up other auto markets and dominate rest of world sales?
Yeah, it's a great point because and honestly, I'm not the right person to ask about how quickly they could snatch up ex-US markets, but there's very clearly a lot of protectionist policies in place to protect the US OEMs here. Because I think that if you gave the United States consumer the choice between a BYD and, one of the US OEM models, the preference would be clear as it sits today if you were paying the same price that they're paying in Europe. So I would imagine like that protectionism, right, is part of a long-term investment in this country of standing by like the US brands. But to your point, like in other parts of the world where you're seeing more consolidation and European OEMs are shrinking, it seems like now your US OEMs going head to head with China and BYD and the likes globally, that race is that gap is magnifying at this point.
Yeah, it would be interesting to see again profitability and then, how much you can reinvest into going back into EVs. If we just look back into lithium and touch on our world, and looking at the quarterlies, I was a little bit thrown at the rate at which SQM increased its sales and what it has planned for the year. I've reloaded that into my models, and then the feedback from IGO and others on what Greenbushes is going to do for the year. I now see the market as far more balanced, if anything, or possibly slightly oversupplied for the year. Your thoughts?
Yeah, I think that's been our view, is that we didn't stay at prices that were disincentivizing activity long enough to really have folks go back to like their flow sheets and say, we're going to stop, expansion in Solars, or we're going to stop like CGP3, Greenbushes, right? So it's like you have already these models that are, pregnant with capital spending that aren't going to slow down until you really start hemorrhaging. And we never got there. So now we're like in this land where, if you're a mature producer, you're still producing probably in like the high 20s, low 30% EBITDA margins, which is not necessarily a bad business, but your full cycle returns are going to be very minimal at best. And I think to your point, I think we can look out to 2028 and see that we're going to be undersupplied. But a lot can happen, obviously, between now and then. And I think our view is that you're far more balanced in 25, 26, and for a portion of 27, unless you see this rationalization of projects that are already planned to come on. And obviously part of that is going to be project failures, which frankly, we really haven't seen yet, but there's a number of new projects that would be coming online in 25 and 26, maybe that would fit that failure criteria and could be deleted from the supply model. But on the other side too is there's always something on the demand side that can change. And we've seen, there can be changes in battery chemistries, and there can be changes in confidence as well. And I think it shouldn't be lost on anyone that EV penetration in China, I think, at an all-time high in the month of May, which was estimated, I think, at almost 47% of new vehicle sales, which is pretty astounding when you think about that market share. And that obviously has been growing as normal auto sales, or just overall auto sales, has been declining. And the Chinese economy has more or less been, quite weak for the last couple of years. So that you've seen some recent government intervention there. And I expect that to some extent, the lithium market is still going to go the ways of the Chinese economy is going to go. And that's true for many critical minerals right now.
So with that kind of in mind, the one bright spot that I see, David, is energy storage and the bigger form factor that's being produced now. it's true, and you're getting cells at $50 a kilowatt hour or less. Do you see any possible, bright lights on the horizon that you could get excess or extra demand as you get the bigger form factor, and you can go into sort of not the 0 to 4 hours, but the 4 to 8 hours, and possibly even 10 to 12 in energy storage?
Absolutely, right. I think, but you and I have spoken on energy storage before, right? So you're dealing with like the law of small numbers where energy storage can be up 50%, but, the total contribution, the lithium demand is not overly impressive. We're still talking about an overall lithium market that's growing 25 to 30% a year right now. And I think even SQM recently blessed that outlook. And if the energy storage market is going to grow at double that, you're still looking at like a contribution margin to that overall growth factor of a few percent a year. So I think it obviously can help on the margin. And I think it's an important secular demand factor, especially when we think about things that are going to have impacts on the grid overall, right? We're seeking an electrification of everything, especially as you look at the proliferation of EVs, but you also see, an incredible groundswell of demand for data centers and AI data centers, which are extremely power consumptive, right? And I think, we actually recently did a multi-analyst collaborative piece just looking at data center demand and looking at electrification demand and ways to address that. And, obviously that's going to be an area where you're going to have some significant applications for energy storage as well, because there has to be a bridge of between interruptible and uninterruptible capacity for load growth.
Yeah, that's definitely something we've looked at. So just to clarify, your year-on-year growth in demand for lithium this year is how much percentage-wise?
In 2024,
Yeah,
I think this year that I'm up 28%.
28.
For
But that's, considering all the press, that's still a pretty good number given where we are at the moment.
no, it's a great number. I think it's just, it shouldn't be lost on people that like supply is keeping up with that, right? And
yeah, but
and I think we're still,
to be
obviously,
fair, David, isn't this like basically 2 years price run back that's now coming home to roost?
yeah, I think that's the same thing that we all talk about of like, if the supply chain is backed up all the way to the cathode maker, like that is the reflection of 2 years of frothy pricing that resulted in overly aggressive procurement. And now it's a matter of like, pricing at $15,000 a ton, $1,200 a ton. That's not like, you're not murdering companies. Like, there's been like a very small handful of folks that go out of business, and the developers, right? Like they might have a harder time finding financing, but one of the things that you guys have talked about is that the natural bridge to market, or the fastest way to get to market, is going to be through hard rock. And I think you're seeing the capital intensity of a lot of spodumene mines that are put out there that are just, astronomically low. And you're seeing like the amount of tonnage that can come out of areas like Brazil that you're like, can be extremely competitive, provided that you can execute on it. And so it's like the market is marinating and iterating on this right now. But, I think it takes some time to destock inventory levels and frothiness of inertia. And it's not going to be just a year and a half. So I think there's reasons to be more optimistic on 2025, just because you're going to have the continuation of that period of time. But I think as you look at balances, like, I don't think that we're materially oversupplied, but I think physically we're relatively balanced, and then you still have the backlog to contend with.
David, you're bringing up an interesting point on the CapEx of hard rock. I want to talk, I think, in between the last time we spoke and now, Lithium Americas, I think, got their loan, or the details of that was announced. And when that came out, the CapEx number was higher, but I also noticed that the interest charge, just the interest charge on the loan before they even, I think even like in Ioneer's case, they're paying interest now just on the conditional commitment. I'm not even sure about that, but the number was $290 million of the overall loan was interest. And when I thought about that $290 million, we represent Atlantic Lithium that's looking to finance their project. That's going to be less than $280 million. Sigma got into production with like $150 million, right? So just the interest. That's one thing. And the second thing is that with cost keep going up and up and up. If you could like shed some light onto why is that? But one factor is like the government's the forcing them to use like kind of union labor. Like on the one hand, it's great. They've got a much bigger loan with a much longer tenor. And it's like the holy grail to get this kind of loan from the government, but it comes with like 25 to 30%, ownership by GM. So is this like, what's beyond all the cost rises, beyond labor, and is this what do you make of this? We're all hoping, right? Ioneer gets it, Piedmont will get it, other people will get, loans, but it doesn't seem as great as it seemed when the government's backing you with 70% funding and, it hasn't done much for the stock either.
Yeah. Yeah. Look, I think that the ATVM loan process under the DOE's loan programs office, right, is not free money. They want to earn a return on the capital that they're putting into a project. So in order to do that, you have to have obviously a very high degree of confidence in being paid back. Like this is taxpayer money. It's not parity. And I think we should all probably feel good about that. As it relates to Thacker Pass and the CapEx associated with 2.9 billion or so, and the DOE loan is in the 2.26 billion range. A lot of that, I think, is contingencies around CapEx to ensure that you're not going to have an overrun over the cost of constructing the project, right? Because your construction timeline is a couple of years. During the course of that construction process, you don't really have an option, or you don't want to be in a position, you can't go back and get another loan. This isn't like an expansionary facility. It's like the facility underwrites the value of the loan, and you're going to have to draw on that over time. So yes, that includes estimated interest, because obviously you have no way of paying down any principal until you're actually producing lithium. So you have a period of time where there's no cash flows. You're going to have contingencies associated with timing, because at this point, to your point, like labor, the real elements of change are going to be the amount of time that you have crews on site, the labor that you're using, and how much they're costing on a daily basis. And then I think, Lithium Americas was including a greater contingency factor to make sure that they could reach final funding to close this loan and not have to go back to the market in any form in order to complete this project. And that's, I think, for any developer that doesn't have any other asset or any other source of cash flow, like you have to kind of project finance that way. And that's, I think again, with the ATVM loan process, once you get a conditional commitment, you then have to close the gap between your expected capital expenditure and the loan amount. And we've seen some instances in the past where companies have not done that, where they started drawing on that loan facility early, and then they realized that, they weren't going to be able to close that funding gap, and then they end up insolvent. And that was obviously something that I think Lithium Americas wanted to certainly avoid. And obviously their partners with GM wanted to avoid that as well.
Yeah, but it's contingent. They have to have all of the equity needs to be spent before the loan is drawn down. And there was a contingent that a certain amount of capital needed to be raised. So that's why LAC raised this $275 million. And now they're going to raise the final bit with GM. Could you explain how that works? Because what price? There's still more dilution to come. We just don't know the price on the GM tranche, and how much equity ownership will they ultimately have of the company?
Yeah, look, I think without getting too far in the details, practically speaking, like the price is going to be determined by like a volume weighted average price. And I can't remember, it was the 10 or 20 preceding trading days. And, there can be arguments of, I think in the past, the way that was written would have been that they get the benefit of like announcing financing so that if the equity responds, then the deal would be less dilutive. But I think for all practical purposes, you can more or less just assume that that 330 million second equity tranche is going to come at current market prices, more or less. And that's obviously going to result in like a pro forma ownership that, is going to be somewhere in the 30+% range for GM. You're obviously going to be below that 50% threshold, but like the, with the loan, that second $330 million tranche will circularly close the loan or satisfy the conditions for the loan. Whereas the loan is also triggering like that second tranche from GM. So they're happening in coincident with each other. So I would anticipate that you see that second GM equity tranche, probably in the next month or so. And then subsequent to that, you would see the DOE loan, final commitment coming out a couple weeks thereafter.
Okay, but essentially it's going to be at market price, $330 million. I thought there was some cap on the ownership that GM could have at 30%. Do you know if that's accurate?
That cap can be waived. I think, I think the assumption is that cap gets waived, that the dilution happens at market. Obviously, it'll be influenced by, I can't remember how many days was included in that volume weighted average price. But, I think you also have to look at it as GM probably just doesn't want to own, 50% of the company, because then you have to think of it as it's a consolidated entity. Whether it's 30 or 34%, I think that's something that can be waived in their agreement.
Okay, so but it's going to be, I mean, the stock keeps drifting down, and it's 330 million divided by whatever the stock is. When they originally did the deal, they thought it would be a lot higher and it would be less dilution. I think you had forecast one time we spoke that the ultimate ownership would only be about 25%. Now you're talking it's going to be north of 30%.
Yep.
So that's been a bit of an overhang, I think, apart from the lithium price. I was also a little bit surprised when I saw that they said the engineering was like 30% complete. Ioneer has been at like 70% completion for like a long time. So I thought that it was much more advanced than that. I don't know if you have any view on that. This is a gigantic project, right? This is a government funded project. I'm joking. I'm coming up with a new name. It's Government Motors Lithium, right? The double entendre,
Yep.
And it happens in China as well. Government Motors Lithium. This is like CATL or BYD, owning a lepidolite mine or something, right? For the local usage.
Yep.
Anyway, let's switch. Any other comments from some of the visits that you, or some of the interviews that you had?
The point that you raised was really one of my largest takeaways from that conversation with Paul Graves at Arcadium, right? Is that James Bay, which is now called Galaxy, as a nice homage to former parent. I think that the idea when they combined Livent and Allkem was that you were going to have a co-located hydroxide conversion facility at Fincourt in Quebec that would take feed from both Whabouchi as part of the Nemaska project, and then subsequently take feed from James Bay. And I think, Paul, obviously chose his words strategically to suggest that perhaps Bécancour, would be an interesting option, or perhaps other places in Ontario would be an interesting option. So I think to your point, one, like the synergies around just building everything out of Bécancour perhaps don't outweigh, some of the benefits of having other partnerships in other areas and having expanded capacity in Bessemer City, where you obviously already have, some conversion capacity there, and be able to benefit from a building out on what would essentially be a brownfield expansion. But I think that would be, pretty fascinating to bring on a mine that would be several 100,000 tons of spodumene concentrate a year, and then perhaps build, a 30,000 ton a year hydroxide facility expansion in North Carolina. With, to your point, you think about hydroxide facilities coming into the United States, and you really don't have that many that are on the docket right now, right? Project Tennessee, I think with Piedmont is still going to be one that They're obviously going to be looking at partnerships, perhaps next year and beyond. And then you have Carolina Lithium from Piedmont, which, successfully won a mining permit, but it sounds like they're going to begin some rezoning work next year. Perhaps there's a little bit of opportunism from Poland, just seeing that the market has a bit of a hydroxide air pocket here, with the only real competition coming from Tesla's refinery over the next few years.
And you seem willing to be selling Galaxy product, spodumene, for a little while as well.
I think that's all like dependent on price. That honestly, I think was their original plan with James Bay, was to just sell SpodCon into the market. And, I think Keith at Keith at Piedmont has talked about at NAL, you're already looking at several $100s a ton by the time you get it over to China, just between shipping and VAT. So it's very difficult to make any margin when it's $900 a ton, but I guess at $1,200 a ton, there's a certain amount of confidence. So even if you get to like a form function of, 10x that of the hydroxide price, if the market can stabilize in this $1,400, $1,500 a ton range when Galaxy comes online, in a year and a half or so, if not a little bit beyond that, why wouldn't you want to use those cash flows, straight some operational, acumen until you brought a conversion facility online? I don't think, obviously, I think that's the other thing that we've seen, and certainly the last couple of years, is there's certainly ample conversion capacity in China, and all of these facilities that have come online on the hard rock side have found buyers over there, albeit at low prices.
Yeah, the problem, the way Paul Graves operates, is if he likes dealing with Western customers, and he likes thinking about, chemicals, and anything that is reliant on the volatile Chinese market gives him agita. So building Galaxy just for spodumene for a few years with no visibility on, it could be 1,500, but it could also be 900. Is something he'll struggle with, but if he can get a Western OEM to guarantee like an integrated thing, and there's maybe 1 or 2 years where he can sell spodumene, it's similar to the way that Mount Holland SQM was planning to sell into the market, but I think they held it back because the prices were too low. So that could happen there. Anyway, but yeah, thank you for bringing up the Carolina permit for Piedmont, which I forgot to mention. At the same time, though, you had Albemarle backtracking on its Carolina plans. I think that's more, they're just shelving all new projects. I don't know that they've, if that's a testament to, I don't know. What do you think? Is there timing on that changed, or is there a permitting kind of consideration, you think, in their mind, or is it just
no? I think it's a risk. I think it's really just a risk management consideration and portfolio considerations, and it gets back to our earlier comments of like, we are not seeing market incentive pricing for North American projects, like full stop, right? Like these projects are not competitive with projects in any other part of the world, like Australia, Brazil, China, Latin America, brine projects, right? Like they're not cost competitive, and they come with a host of other issues, certainly on the permitting side. So I think for Albemarle, they look at their portfolio and what are they going to participate in right now? They're going to participate in funding expansion, obviously at Greenbushes and Wodgina. They're going to participate in continuing to build out their Kemerton hydroxide conversion facilities in Australia, and then commissioning new facilities in China. And then they obviously have the completion of their solar yield enhancement projects in Chile. So I think it's just a matter of like, the company's outspending cash flow this year. I just think that for the time being, it would be imprudent to really suggest, outside of receiving like a significant injection from a partner that wanted to guarantee you a premium price in North Carolina, why pursue that project right now? You have a balance sheet to manage.
Let's see if Piedmont gets the rezoning, post the election, and that's moving forward. Then maybe Albemarle thinks, oh, okay, if they can get permitted, we're
I don't think that
20
there's
miles away.
Yeah, I'm sorry to interrupt. I don't think that there's any lack of confidence on Albemarle's part that they can get Kings Mountain permitted. And I think it's, this is not a greenfield facility, and I think that they view their rezoning issues as being less than Piedmont. So I think there's still quite a bit of confidence. They've done a lot of community relations in advance. So like the community relations side is something that Piedmont is focusing on quite a bit right now. But I think that's something that Albemarle has been doing for quite some time. I think ultimately it just comes down to, is this an economically viable project and one that would compete for capital relative to all of our opportunities that are out there right now?
Okay, I think let's leave it at that. David, thank you very much for this just an interim, recap on the back of your conference, and I look forward to seeing you at the Fast Markets conference, if not for coffee in New York before that. But Rodney and I will be there. I know you're moderating some panels, as Rodney and I are, and that's just a few weeks away. I have used, by the way, the weighting was used for critical elements in our most recent video. Waiting in vain, I mentioned in my, February, Bob Marley One Love one, but I haven't actually used it specifically. And then patience, though, that's a good one. I haven't used that yet. So maybe that will be the one. Guns and Roses.
Patience has a very long intro, so it's not as catchy, but it is a seasonally appropriate time, I think, to introduce some Bob Marley. The sun is shining, right?
Oh, okay. Don't worry about a thing. Everything is going to be all right. I've used that multiple times. Okay. Thank you, David.
Thank you, guys. Great to see you both.
Yeah.
Yeah.
Cheers.
Cheers, man.